2/3 of Americans claim Social Security before reaching full retirement age. The financial media frames this as a collective planning mistake, as if everyone keeps making the same mathematical error over and over. But there's a truth nobody says out loud. Sometimes claiming at 62 is not a mistake. Sometimes it is the smartest decision you can make. The conventional wisdom is simple: wait as long as possible. Delay until age 70. Every year you delay, your payment grows by 8%. At 70, you receive 124% of what you'd get at 67. Sounds reasonable, doesn't it? But this view rests on many assumptions about your life. It assumes you will live long enough to reach the break-even point. It assumes you don't need the money now. It assumes your spouse isn't waiting on your claim to start their own benefits. It assumes your health is stable. It assumes you have no other income source. For some people, those conditions hold. For others, they are entirely wrong. For those born in 1960 or later, full retirement age is 67. If you claim at 62, your payment is permanently reduced by roughly 30%. If your retirement benefit would be $4,000 a month, starting at 62 brings that down to roughly $2,800. If you wait until 70, that number climbs to nearly $5,200. The difference is over $2,200 per month. Comparing claiming at 62 versus 67, the break-even point is around age 78. Comparing 62 versus 70, it's roughly 80 to 81. Comparing 67 versus 70, it's around 82. The Social Security system is designed around average life expectancy. Someone who lives an average lifespan receives roughly the same total benefit regardless of when they claim. The difference is simply in the timing of when the money flows. Reason 1. Claiming starts spousal benefits. Your spouse cannot receive spousal benefits until you file for your own retirement benefit. If your spouse didn't work enough, or their benefit is less than half of yours, they depend on you filing first. The spousal benefit can be up to 50% of your benefit at full retirement age. If you wait until 70, your spouse goes 8 years without any spousal benefit. That is 8 years of household income surrendered. Think as a household, not just as an individual. Reason 2. Your health suggests you may not live well past your mid-70s. Nobody finds it easy to assess their own mortality. But insisting you'll live to 90 when your family history and current conditions say otherwise isn't optimism, it's poor planning. The average American who reaches 62 can expect to live about 22 more years. But that's an average. Half live longer, half live shorter. If you have chronic health conditions or a family pattern of early death, the calculation changes. In this scenario, claiming early maximizes the total amount you collect over your actual lifetime. The higher payment at 70 is worthless if you don't live to see it. Social Security is meant to function as insurance. If your retirement is likely to be shorter, the insurance should pay out earlier. Reason 3. Your spouse has a shorter life expectancy and you may collect a larger survivor benefit. When one spouse dies, the survivor can switch to the deceased spouse's benefit. This is called the survivor benefit. If you have a serious health condition and your spouse has a higher earnings record and longer life expectancy, you can claim early on your own record. When you pass, your spouse continues on their own higher benefit. Or the reverse, your spouse has a significantly higher benefit but a shorter life expectancy. You claim early on your own record, and when your spouse dies, you switch to their higher survivor benefit. Income from both sources, but in the right sequence. If there is a meaningful life expectancy gap between spouses, you must run this calculation. Reason 4. You are retired, not working, and you have a substantial investment portfolio. This surprises people because it's counterintuitive. If you have significant portfolio assets, those assets continue to grow. But when you withdraw from those assets, the withdrawn amount can no longer grow. By claiming Social Security early and covering some living expenses with those payments, you withdraw less from your portfolio. Your investments grow for a longer period. In some scenarios, 8 additional years of portfolio growth outweighs the benefit of waiting. This strategy also reduces what financial planners call sequence of returns risk. If you are withdrawing heavily from your portfolio during a market downturn in your early retirement years, the damage can be permanent. Social Security income acts as a buffer that protects your portfolio during that window. Reason 5. You are not working and you plan to invest the payments. Some people deliberately claim Social Security early specifically to invest the payments. Claiming at 62 gives you 8 more years of payments compared to waiting until 70. Each payment is smaller, but you can invest those payments in the market. If your returns exceed 7 to 8% annually and you live long enough, the invested early payments can outperform the delayed larger ones. This is an aggressive strategy, and it carries risk. Markets do not return 8% every year. In bad years, you can lose 20%. But for people who understand the risks, have a solid investment background, and don't rely on Social Security for daily expenses, this is a legitimate approach. You are essentially betting that you can outperform the guaranteed 8% return that waiting provides. Reason 6. You have another guaranteed lifetime income source starting later. Say you are 62 and have a pension starting at 65. Or you purchased a deferred income annuity years ago that kicks in at 67. In that case, your later years are already anchored by a combined income base. You don't need to maximize Social Security because you've already built that foundation. Claiming early to bridge the gap between 62 and 65 or 67 becomes your bridge income. When your other source starts, the combined income exceeds your needs and Social Security becomes supplemental. Reason 7. You cannot work past 62 and you need the money. Sometimes life doesn't go as planned. Maybe you worked in construction, manufacturing, or physical labor, and by 62, your body simply can't continue. Or you were laid off and nobody is hiring someone your age at the salary you need. Age discrimination is illegal, but extremely difficult to prove. Many workers in their early 60s never find a comparable position after losing a job. If you cannot work and your savings are not enough to cover the gap, Social Security exists precisely for this. Using it when you genuinely need it is not a failure. That is the purpose of the system. Now let's look at situations where claiming at 62 is almost certainly a mistake. If you are still working and earning significant income, claiming early is likely a mistake. For 2026, the earnings limit is $24,488. If you earn above this limit while collecting benefits, $1 is withheld for every $2 of excess earnings. You are permanently reducing your benefit by 30% while also having payments withheld. Financially, this makes no sense. If Social Security will be your only or primary income in retirement, seriously consider waiting as long as possible. The difference between $2,800 and $4,100 a month is the difference between a comfortable retirement and a struggle to get by. If longevity runs in your family and your health is solid, waiting will likely pay off. There are over 700 distinct Social Security claiming strategies, and the basic break-even analysis is only a starting point. Make your decision with knowledge, not with fear.